Hello, everyone, and welcome back to a new episode Behind the Well. Today, it's a very special episode because we have as a guest our senior manager, Joshua Barnard, a very experienced chartered accountant with many years of experience in the field. And the reason we have Josh in our Behind the Wealth series is because on the private conversations in the office, me and Josh, we always talk about different subjects in the economy, the shares, the property, the markets. So I thought why we don't have a bit more public discussion about a subject that I think it's very interesting, close to most of us, close to our heart. So today we're going to talk about interest rates and effect it has in our wealth creation and what we can do if we have any problems or issues. So first of all, I want to welcome Josh to our conversation.
Thanks for having me.
And secondly, and very important, I have to say the normal statement, please, whatever we say today, it is not an advice. We don't know your personal circumstances. It's a general advice. And if you need to talk a bit more in detail about the subject, please call us on 0296 007760 or call your accountant or your financial planner. So let us start. So Josh, what's happening with the interest rates?
Well, they keep going up.
What is your view about why the interest rates are increasing and rising since May 2022?
Yeah, so we've had back-to-back interest rate rises, and thankfully they started to subside. We had those big jumps in the previous months of 0.5s. They're back to 0.25s, thankfully, and hopefully they're going to stop soon. But it has been a rough ride and a very rapid increase in interest rates over this past 9 months or so. And so where is it? What's it caused it? Well, inflation. We've had inflation constantly and at very, very high rates, well outside the RBA's target range for inflation. And so their main lever that they can pull to try and bring that economy back into line with what they expect and to keep the inflation under wraps is to try to stop spending.
So the inflation rate is currently above 7%, and unemployment it is historically low, 3-something%.
Yeah.
So these two combinations makes it a little bit of hard for the RBA to contain, because we have a demand on employment and we have high inflation, and so means that the economy has to slow
supply
down.
constraints. So we're getting it from all angles: supply, wage growth, and it's all turning into a storm of interest rate.
I know from people, for example, in agricultural items, they had massive orders waiting for them to arrive, and massive orders here in Australia, but they're not coming. So really, there is no discount. They sell whatever they have at stock. And the greatest fear is that when the stock arrives in 6 months' time, the demand won't be there because the people won't survive this extra 6 months that they want this equipment at today environment. So everyone is really on the edge. Mostly the fear, I think, and the uncertainty. It is. How do you see the rate increases, and how, if you are the household owner that who has his primary residency, or you have 1 or 2 investment properties, and you can see on $1 million, for example, loan, just to make it easy to calculate, and increase almost 2.5%, it is another $25,000 just on interest. And if, of course, it's a substantial amount of money for any average household. So how we can help our listeners and what we can provide as suggestion, things for them to look into to maintain the repayments, to pass through that storm?
Yeah, and I think this depends on exactly what your personal circumstances are, of what level of difficulty you're having. If it means that we're dialing back our discretionary spending and that's enough, then that's great. But either way, some of these strategies will help no matter what, because at the end of the day, we want to pay as little interest as we can and try to pay down those loans as quickly as we can. So I think the best way, the first port of call would have to be to talk to your bank or talk to your finance broker. A simple phone call to the bank, a prepared phone call, when you know that you've Googled and you found a comparative rate with a very similar loan product from a reputable bank. If you can call that bank and say, hey, I can see over here, this other big tier bank has an interest rate of 0.5% less than what I've currently got, my variable rate, then that's good ammunition to go at them to see whether they will give you a drop. And I've heard of many clients having success with that. I personally have had success with that, and I've had the bank reduce their interest rate off of a simple phone call. And the broker is the one who's in your corner fighting for your best outcomes. They're the ones who know the interest rate market. They know what loans are available. They know whether interest only is an option, which can have some increased interest costs, but some improved cash flow. It could be an option. And in a worst case scenario, we could head into worst case, but another option would be to head into a full refinance with a different bank. If the bank doesn't want to play ball, then the broker is going to be able to recommend whether they can get a better rate elsewhere. And the good news is that there is a lot of competition between banks, from what I understand, that they are wanting more business. There are people offering cashbacks on refinancing, and there is a bit more fat in their margins where they can negotiate a bit more than they have in the past. So that's got to be the number one.
And also, I think having a mortgage broker or a relation with your bank, it adds value that they know your circumstances, they know your affairs, so it'd be easier for them to assess, say, a mortgage broker, to assess if you can move your refinance without really do a full application. And even if you don't have a mortgage broker, I agree. If you have a phone call, usually after you do the homework, I think this is the key word, homework. Yeah. So you know what you demand and you ask, and you have ammunition in these conversations to make your point. Usually it's very effective. The other one I want to discuss is what about if I already paid extra repayments on my home loan, investment, or mortgage or primary residency home loan? So because I'm supposed to pay, say, $1,000 a month, but because I work, my wife works, and we are good savers, we pay $1,100 over the years. So really, the $1 million loan that I had, now I paid extra on top of my time, say $30,000, $50,000, $100,000, because I'm a good saver and I pay extra. What we could do with that scenario that already overpaid a little bit of my loan, of the 25 years loan, or 30 or whatever.
And that's got to be the simplest and quickest way to get a really quick result of dropping that repayment down, is to go ahead and to contact your bank and talk to them about whether you should crystallize some of that redraw or allocate some of your offset savings and actually allocate them to pay down the loan permanently. I guess that's got to be done with great care, because that is permanently locking away access to those funds. So that has to be truly spare, not the rainy day money that you're having there just in case the hot water system blows or something like that. This is truly things that you've set aside in your mind to say, no, I've paid down that loan. I'll never want to redraw it again. And I'm happy to crystallize that so that my repayments come down. That's going to instantly drop those repayments very quickly.
You need to check with your bank what's happening after you do that before you do it. You need to have confirmation. Of course, you have a mortgage broker is going to do the legwork for you, but if you don't, you need to make sure that you understand the implications of that you really lock up the money that you paid it off over the years because you are a good saver and overpaid it. They're going to disappear. You don't have access. That's a very important stuff to remember, and not to but what it does it diminishes really the repayments of the mortgages. So it eases the burden of you that the 25 points or 0.5% extra created on your repayments if you're struggling. But we forgot the most important thing. I'll probably go to the next step, and I go there to the most important thing that actually I wanted to start, and I missed that. Is about if we have offset accounts, of course, we can use the offset accounts to help. And also, what about if I have extra repayments, $100,000 on my $1 million loan, and then suddenly I don't do any repayments because the bank doesn't see that I haven't met my repayments because I'm already over by $100,000. So for a few months or few weeks or maybe few years, the bank doesn't see that I don't do repayments because I already done repayments extra by $100,000 or whatever it is the amount. And this is a more easy solution if you are in circumstances like this, if you are in a situation like this. Are you agreeing with that?
Yeah. And to be an element of that is that if you're $100 a fortnight short, then we can eat away into that if we need
Correct.
to.
That's the point. You can eat away if you are a shortfall of that by doing that, by doing using the already credits that you had from overpayments. But I think the first point we have to address is your budget.
Yeah.
I think that's the first thing you have to start. When we have a crisis, a little bit of an issue with repayments of interest rates, the first thing is to address your budget. And we done an episode, I think 2 weeks ago, addressing the budget, and we went through why we need to do that. We won't go back again to that. They can log into and listen to that. But it is the budget, because a lot of times we have a lot of extra fat in that we can cut a little bit. Not all of us, but many of us. Before you do the phone call. The phone call is also important because it saves you the 0.25%. That one doesn't mitigate the other, correct?
Correct. Yeah, it's as many savings as we can get across the board, the better. And there's always sneaky spending. There's sneaky subscriptions that we haven't cancelled that we forget that keep coming out. Of just realizing just how much those coffees add up to be and all that type of thing. And knowing where you can cut back without hampering your lifestyle the budget's going to tell you that story very quickly. So,
and I find in any problem we're facing, there is an opportunity. This little stress or a lot of stress some people they have or may have, they need to then go and look back to their fundamentals and see what I did wrong, what I've done right, what I could do better. How can I manage my cash flow better? How I can automate my savings for later on for a rainy day, and that pays later on if we have another crisis. So, but going forward, what is your view for the interest rates? I know we don't have a crystal ball and we don't know really what's going to happen, but there is a lot of evidence that we are very close to the top of the interest rate cycle this time. Maybe we have another one, maybe not, but we are very close because also interest rates have a bit delay effect, 3 to 6 months or even longer to have an effect.
And particularly for those fortunate people who are still on fixed interest, who haven't felt these rises, or they felt it on a reduced because they're 75% fixed, 25% variable or something like that. Those people still haven't felt the full impact of this on their budget. So that's another thing that I think is really worthwhile for those out there who do have fixed interest components still and haven't come off that yet, is to hop on and there are calculators you can run on the internet to figure out what your repayment will be once you come off of the fixed interest. And if you possibly can, have your repayment already at or above that today so that you know what it feels like. In the meantime, before you come off fixed rate, that's all going to go into that buffer. It's all going to go into that redraw. It's still available to you, but you'll know what it feels like so we can prepare so that it isn't that massive shock once we come off of those fixed interest.
And also, if you know your fixed interest is maturing, say in May, Don't wait till June when you receive the letter that, or in end of May, to receive a letter from the bank that they changed. Start working from now with your bank, with your broker, with your affairs, with your tightening your budget. If you need to refinance, cancel and tighten up your budget to look more attractive to the person who will assess your new loan. So be proactive. See what is your options. Maybe if you are a strong financially person and stable job for a long period of time, maybe you don't need to go to the top tier banks and go to the internet ones that they provide only through the internet, more selective because they want, or if you have a lot of equity in your homes or your investment. So maybe you don't need to go to the traditional, you go to the banks that specialize in giving cheaper loans if you have a lot of equity, say 50%, 60%, or 45%, compared to someone else that he has only 20% equity. Do you agree? So it's a lot of institutions. If you have equity or enough equity, they give you a little bit discount on the interest rate because you consider a safe bet for them.
Yeah. And that's where the broker is really going to come in and have a look at all those different options to see what's available to you.
Now, the question are we facing again and again and again. I have a property, my primary residency, and I have an investment property. And the interest rate is killing me. What should I do? Should I sell my investment property? Because it's going up and up and up.
That's a good question for your financial advisor, I think. I think one thing to consider there, or from a tax point of view, is that we don't want to pay tax for, so we don't want to pay money just to claim a tax deduction. We don't want to pay $1 just to get 39 cents back. That doesn't make any sense. But if we have no choice and we're paying that interest, just keep in mind that we are going to be claiming a tax deduction for those extra interest payments that we have as the interest rates go up on that investment property. So we do get to claim a bit more, get a bit more back in tax, which helps to mitigate the cost of that. And so, yeah, do you need to sell that investment property? I would hope not. What are your thoughts?
I think an investment property is a long-term investment, 12 to 15 years. If you've done your homework, you probably had the worst-case scenario with interest rates increase at least 2-3% or 1.5%, 2% extra when you've done the initial calculation. So you're very close to your worst-case scenario. I believe in everything in life, there is a good time and bad time. So I consider this increasing of interest rates and inflation, it's a storm. So we really want to pass that storm. And selling an investment property in a normal circumstances, I mean, in the average circumstances, the decision is a good property or not? Is going to continue to appreciate? It serves my long-term plans, my retirement or wealth creation plans. And the interest rate is one of the factors of considering everything regarding the property. It's not just the factor. And then we put strategy to mitigate this or contain this or manage this, because it is a storm, and we've been through that. People who are older like me and you, we've been through that. And a rainy day is followed by a sunny day. So the aim, I think, is to try to hold on that if the property is worth holding it, and if it meets your bigger and longer goals, on time frame goals. Now, if it's a crap property, it doesn't really matter if it is the interest rates going up or down. You should get out and do something better because you missed the opportunity. So I think the question regarding selling the property, it's a very illiquid asset. It's very costly to get in back. It's very costly to get out. Usually it's capital gain issues. Then, and it needs to fit the longer purpose or your longer goals, long-term goals. You can sell an investment property, cash in because you want to upgrade your primary residency. But this is not because of the interest rate per se. The interest rates could have an effect, but it's not per se the interest rate. So on a personal level, I think I'm a holder because we don't trade properties, we invest for the long term. But of course, everyone has a different personal circumstances, and he needs to assess this with a financial planner or their accountant. And he needs to, a lot of mistakes I find out, they sell the investment properties and they don't talk to the accountant. What is the tax implication? Which is a phone call, because for you, it's just 2 minutes calculation and you almost exactly tell him how much extra tax he needs to pay, because you have his tax returns, you have everything, and you can assess it pretty close.
How many times I've had that conversation with a client and I tell them what that tax bill is going to be and they go, not worth it. I'll hold on to it. Yeah. But we need to have all of those facts in line before we start making those big decisions, because it's critical.
So what is the moral of the story on an environment of increasing interest rate?
Savings and budgeting has to be the biggest one. And talking to your bank and your broker to make sure you've got the best deal. That interest savings from on the bank side can have some really quick effects. And looking at what's in your redraw and knowing that that's a buffer in place. Go home and check your banking. Sometimes it sneaks up just by simply paying fortnightly. That will have been accruing redraw automatically. You're actually paying extra by paying fortnightly. So sometimes people don't realize that they actually have money available sitting there. So
yeah, I think, and I'll add just very little, that be prepared also if you're coming out of a fixed interest from now with your affairs and your investigation. So don't wait either last minute. Don't forget, it is a storm. It is a storm that will pass, and with better days regarding interest rates and inflation. Anything else to add?
Yeah, and get those experts in your corner. So yeah, talk to your financial advisor, talk to your mortgage broker, and talk to your accountant if things are tough. And if you're looking at making big moves, then you need to speak to the experts to get the right advice.
All we want to do is, before we do any decision, to tick all the boxes, that we have all the information and all possible solutions and scenarios, and then make a decision. And then that decision we make on that day, having all the facts with today's knowledge and today's environment and today's circumstances, is going to be a good decision, because we assessed everything. Now, in the hindsight, 6 months later, a year later, maybe we say, oh, we shouldn't, we should, but it is irrelevant. Only we can do with the facts and the knowledge of information we have today. But we need to go box by box and tick it. We ask all the experts, we explore all possibilities, do the work, do the legwork, the effort to investigate. And then I think we're going to have a good solution to the problem, if there is a problem.
Yeah, absolutely.
All right, Josh, thank you very much for your time. And thank you, everyone, for listening to us. Till next time, have a good day.